In our last episode, we laid the foundation. We learned how to read the market's direction with trends, identify its memory zones with support and resistance, and measure its conviction with volume. If you missed that video, I highly recommend watching it first. Today, with that solid base, we start building. And we're going to start at the very top of the mountain. We're going to study the patterns that announce the party's over. These are the formations that, when they appear at the end of a long uptrend, act like a warning siren, signaling that the bears are about to take control. These are the giants of change. They are the most important and reliable bearish reversal patterns in technical analysis. In this episode, we'll focus on two titans, the legendary head and shoulders pattern and the powerful double top. Understanding their anatomy and, more importantly, the psychology that drives them will give you a critical edge to protect your profits and anticipate major downturns. Get ready, because we're about to learn how to identify the beginning of the end.
If there were a Hall of Fame for chart patterns, the Head and Shoulders, or H&S, would have its own pedestal. It is, without a doubt, the most well-known bearish reversal pattern and one of the most reliable. Its name perfectly describes its shape, but its true power lies in the story it tells. Let's break down its anatomy. Every Head and Shoulders pattern has 5 key elements. First, the left shoulder. This occurs within an established uptrend. The price rallies to a new high on significant volume, reflecting the prevailing optimism. Then a normal pullback occurs, forming a low. So far, everything looks normal for the trend. Second, the head. From the low of the left shoulder, buyers push the price up again, this time to an even higher high. This is the head of the pattern, the peak of euphoria. But here's where the first warning sign appears, and it's crucial. Often, this new high is formed on decreasing volume compared to the left shoulder. The price is going up, yes, but with less participation, less conviction. The fuel is starting to run low. After hitting the peak, the price falls again, usually to the same level as the previous low. Third, the neckline. This is the most important element for confirmation. We draw a straight line connecting the two lows, the one created after the left shoulder and the one created after the head. This line, which can be horizontal or slightly sloped, is our line in the sand. It is the pattern's critical support. Fourth, the right shoulder. After touching the neckline, buyers attempt one last rally. The price moves up again, but this time, and this is fundamental, it fails to reach the high of the head. This failure is a demonstration of terminal weakness. Psychologically, it's the bull's last gasp. The volume during the formation of this right shoulder is usually anemic, confirming the lack of buying interest. And fifth, the breakdown. The pattern is completed and confirmed when the price, after forming the right shoulder, falls and breaks through the neckline decisively. Now, let's go beyond the shape and understand the psychology. The left shoulder is the late-stage optimism of the trend. The head is peak euphoria, but it's already showing internal cracks with the volume divergence. The right shoulder is denial, the desperate attempt to continue the rally that fails miserably. The breakdown of the neckline is panic. It's the capitulation of buyers and the aggressive takeover by sellers.
Let's look at a real example. Look at this uptrend. Here we have the left shoulder with good volume. Then the head, a higher high, but look at the volume. It's lower. The price pulls back to this level, which we connect to form our neckline. And here, the rally attempt of the right shoulder. Weak, no power. It dies out long before reaching the head. And finally, the breakdown. Look at the volume on the breakdown candle. A spike. That's the confirmation we were looking for. But how far could the price fall? The H&S pattern gives us a measurable price target. The technique is simple. Measure the vertical distance from the highest point of the head down to the neckline. Then project that same distance downward from the point where the price broke the neckline. This calculation gives us a minimum price target for the drop. Often the price falls much further, but this projection gives us a logical zone to take profits on a short position.
The head and shoulders is a complex story of gradual exhaustion. The double top is a direct, brutal blow. It's a clear and powerful demonstration that there's a resistance level that buyers simply cannot break. Its formation is simpler. At the end of an uptrend, the price hits a high, pulls back, and then rallies again to try to surpass that previous high, but fails, stopping at roughly the same level. We have two peaks at a similar height, forming a sort of M shape. The psychology here is one of buyer frustration and exhaustion. The first peak is a normal high. The pullback creates an intermediate low, which we call the valley. This valley is crucial because its price level forms the neckline, the equivalent of the H&S neckline. The second attempt to rally is the moment of truth. By failing to break above the first peak, the buyer's confidence evaporates. They realize there's a wall of sellers in that zone, and the energy to break through it just isn't there. Confirmation of the pattern, just like in the H&S, comes with the breakdown of the neckline. When the price falls below the valley, the sell signal is triggered. And once again, volume is our ally. A breakdown on high volume is a much more reliable signal. The triple top is an even more potent variation. It's the same concept, but buyers try to break the resistance a third time and fail again. 3 failed attempts send an even more powerful message of buyer weakness and seller strength. The psychology is that of a failed siege. After the third attempt, the attacking army retreats in disarray.
Here we have a clear example. The price rallies, forms the first peak. It pulls back, creating our valley. Here we mark the neckline. It attacks the resistance again, fails, and the second peak is formed. The weakness is palpable. And here is the key moment, the breakdown of the neckline. The pattern is confirmed and the downtrend begins. And the price target? The logic is identical. Measure the height from the peaks down to the neckline or valley. Project that distance downward from the breakdown point. It's a simple and effective method for estimating the potential scope of the new bearish move.
So, let's recap the giants of bearish change. The head and shoulders is a 3-thrust pattern that shows progressive exhaustion, with the head as the peak of euphoria and the right shoulder as the final failure. Its confirmation is the breakdown of the neckline. The double or triple top is a test of strength against a clear resistance. It shows the repeated failure of buyers to create new highs. Its confirmation is the breakdown of the neckline or valley. Both patterns are incredibly powerful because they aren't just shapes on a chart, they are stories about the shift in power from buyers to sellers. Learning to read these stories in real time is a skill that will put you ahead of the crowd. But what happens when the story is reversed? What happens when, at the end of a long and painful downtrend, patterns appear that announce the birth of a new bull market? That's the topic of our next episode. We'll flip the script and study the bullish counterparts of these patterns, the inverse head and shoulders, and the double and triple bottoms. We'll learn to identify seller capitulation and the stealthy entry of buyers, the signals that mark the end of winter and the beginning of spring in the markets. If you're ready to learn how to spot market bottoms, subscribe to Money Talks US and don't miss the next chapter of The Secret Language of Charts. Knowledge is power.